which excludes food, fuel and electricity, declined to 4.2% in June. Producer price inflation for final manufactured goods increased marginally to 4.6% in May. Despite remaining within the target band throughout the forecast period, the SARB's model projects an increase in headline inflation, peaking at levels closer to the upper end of the target range. Thus far, the impact of the VAT increase appears to have been less than anticipated. However, the weaker rand exchange rate and higher oil price assumptions result in a more elevated inflation trajectory. Headline inflation is now expected to average 4.8% in 2018, before increasing to 5.6% in 2019 and 5.4% in 2020. Headline CPI inflation is expected to peak at around 5.7% in the first and second quarters of 2019 before declining to 5.3% at the end of 2020. The forecast for core inflation is 4.6% in 2018, 5.5% in 2019, and 5.3% in 2020. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research during the second quarter of 2018, are largely unchanged in the near term, averaging 5.2% in 2018, 5.4% in 2019, and 5.5% in 2020. Five-year inflation expectations are at a historic low of 5.4%. Inflation expectations implicit in the break-even inflation rate, that is the yield differential between conventional and inflation-linked government bonds, declined marginally across all maturities. While the global economic outlook has remained broadly favorable, expectations are that world growth will begin to slow in the third quarter of 2018. In addition, escalating trade tensions are contributing to uncertainty regarding global trade. World trade volumes contracted sharply in April 2018, the worst performance since May 2015. The global inflation outlook remains benign, but is on a moderate upward path, largely due to rising oil prices. Prices of most other commodities have been retreating. Since the previous meeting of the MPC, the rand has depreciated by 7.2% against the US dollar, by 6.2% against the euro, and by 4.9% on a trade-weighted basis. At current levels, the SARB's model assesses the rand to be undervalued, and it is likely that the rand, along with other emerging market currencies, will remain volatile. The implied starting point for the rand is 13 rands 40 against the US dollar, compared with 12 rands 37 at the time of the previous meeting. A key external risk to the rand remains the possibility of tighter global financial conditions. However, the pace of monetary policy normalization in the advanced economies continues to be gradual. At this stage, further policy tightening by the US Fed is expected to follow a measured path in the absence of significant inflation or growth surprises. Higher than expected US fiscal deficits could result in a stronger monetary policy response. The domestic economic growth outlook for this year is weaker than we expected in May. Following a broad-based contraction of 2.2% in the first quarter and early indications of modest growth in the second quarter, the SARB's forecast now indicates a growth rate of 1.2% for 2018 compared with 1.7% previously. The forecast for 2019 is 1.9%, marginally higher than the previous forecast of 1.7%, while the forecast for 2020 is unchanged at 2%. At these growth rates, the negative output gap is wider in the near term, but is still expected to close in 2020. The composite leading business cycle indicator declined for the second consecutive month in April, consistent with a deteriorating outlook. Business confidence, as reflected in the BER Business Confidence Index, decreased to 39 index points in the second quarter. In this context, gross fixed capital formation contracted by 3.2% in the first quarter and is expected to remain weak in 2018. Consumption expenditure by households, although slightly weaker than last year, is expected to be positively impacted by the improved consumer confidence and the increase in household disposable income. In the near term, however, consumption expenditure is likely to be constrained by the VAT increase and other tax changes, weak employment growth, as well as subdued growth in credit extension to households. Although credit extension to households increased earlier in 2018, year-on-year growth remains low. Average wage growth is expected to remain elevated at around 7% over the forecast period. This is particularly a concern if labor productivity growth continues to decline. Much of the upward pressure on wage inflation arises from the public sector wage settlement, which is at levels above headline inflation. Higher international oil prices will contribute to petrol price inflation in 2018. The impact on headline inflation is somewhat moderated by lower food price inflation. Annual food price inflation is expected to remain within the target range over the forecast period and is not seen as a major risk to the inflation outlook. This is largely driven by adequate supply of grains over the near term alongside moderating meat price increases. The MPC noted the rising inflation trajectory, which, while remaining within the target range, is moving closer to the upper end of the target range. Key uncertainties in the global environment remain. The continued strength of the US dollar, which has appreciated against most currencies, any sustained elevation of oil prices, escalating trade tensions and geopolitical developments could continue to pose risks to the inflation outlook. The rand will remain sensitive to changes in global monetary policy settings and investor sentiment towards emerging markets. The committee assesses the risks to the inflation forecast to be on the upside. A number of key risks and uncertainties highlighted in recent meetings persist. Electricity prices continue to pose a further upside risk. The growth forecast has deteriorated and the outlook remains constrained. Demand pressures in the economy are not assessed to pose a risk to the inflation outlook. The MPC assesses the risks to the growth forecast to be more or less balanced. A firm commitment to credible structural policy initiatives and implementation is required to make a marked impact on employment and potential output. The MPC unanimously decided to keep the repurchase rate unchanged at 6.5% per annum. At these levels, the committee still assesses the stance of monetary policy to be accommodative and appropriate given the current state of the economy. However, the MPC has noted the deteriorating inflation outlook, driven mainly by supply-side factors. The approach of the committee continues to be to look through the first-round effects and focus on the second-round effects. With risks and uncertainties at higher levels, the MPC will continue to be vigilant and will not hesitate to act should there be second-round effects that takes us significantly away from the midpoint of the inflation target range. The implied path of policy rates generated by the quarterly projection model has changed since the previous meeting. Whereas previously 4 increases of 25 basis points each by the end of 2020 were indicated, 5 increases of 25 basis points are now implied. As emphasized previously, the implied path remains a broad policy guide which can and does change in either direction between meetings in response to new developments and changing risks. The MPC does not mechanically respond to changes in the path, and the assessment of the balance of the risks to the forecast cannot be done by the model. That concludes my statement, and as usual we are available for questions, and please identify yourself and the media house that you are affiliated to, and the panel will then deal with your questions. Yes, ma'am.
Good afternoon, Governor, and thanks for the opportunity. It's Anna Montero from Bloomberg News. I'd just like to know what the MPC thinks of the potential ESCOM wage settlements and the public sector wage settlements being at between 7 or 6 and up to 7.5%, and how much of a concern that is for your model. Thank you.
Yes, sir.
Governor John Bailey, ENCA. What will be the impact of this trade war between China and America? What impact will that have on the local economy?
Yes, ma'am.
Afternoon, Governor. I'm Khelang Bata from Bloomberg News. You've said in your speech that domestic growth outlook remains challenging. I mean, a few years ago, we knew that the electricity supply problem was one of the key factors that inhibited growth. Can you give us an outline of some of the factors that the SARB sees as inhibiting growth at this point in time?
One more. Oh, okay. What would be the impact of the potential wage settlements at ESCOM? You would realize we talked about the public sector wage settlements, and if you decompose what has been happening with wages across the economy, you will find that public sector wages have been rising faster than private sector wages, and as such, the key then domestic driver of inflation from the wage side is from the public sector. So whether it is just government or you include ESCOM, that is what we had seen, because all the settlements have been above a headline, not just above the target range, but even far above the existing inflation or the most recent inflation outcomes. John, the impact of the trade wars, they are quite telling on the global economy. And for us to understand this, let's take a step back and remember that in 2008, at the advent of the global financial crisis, global trade collapsed, and the focus of the global community was to then restart global trade flows. And in that process, we had, as a global community, have to look at what were the constraints to trade growth. And amongst those at the time that were identified had to do with the decline in trade finance as a result of the collapse of the international financial system in financial systems in many of the developed countries. What made the 1929 economic crisis really a depression was the surge in protectionism which depressed global trade. And what you are going to be having now, if this trade wars materialize and there is a rise of protectionism, small open economies will feel the pain immediately. Because for many small open economies, we are hooked into global value chains. And when there is protectionism in the major markets, that means that small open economies that depends on exports can no longer sell there. I think that, yes, we will be the immediate losers as small open economies, but overall, as a global community, we will all be losers from the trade wars. No one can gain from these things because it's going to, you see, once you start a war, you are not going to be the one to stop it because everyone will then try to hit back. Unfortunately, small open economies do not have the wherewithal to hit back. Our markets are small. We are depending on having to sell into the global economy. And many countries in the world are actually small open economies. So that is how we think about it. Of course, besides growth, we do know that a rise in protectionism does lead to a rise in domestic prices. And so in many of the countries where they decided to embark on protectionist measures, there is bound to be reduced competition in those markets, which then means that the pricing power of producers in those markets increases, and as such, inflation is bound to rise in those markets, other things being equal. Amkhalang, we have been at this before. We had said that the stuff that inhibits growth are structural in nature. And structural policies take time to fill in, but there are a lot of other low-hanging fruits. We are a beautiful country. We are a beautiful country, which means that we are endowed with very good tourism assets. And I'm sure if we were to make it easier for the tourists to be here, we would benefit from that. For a long time, we had talked about migration to digital signals so that broadband bandwidth spectrum can be released. That does not take rocket science, that if you release spectrum in the era of the 4th industrial revolution, you are actually spawning new industries to come in. But we have also got to get investment going in this economy. And we had initially seen a rise in business confidence and consumer confidence. And there needs to be a conversation that would get business confidence going once again so that investment can actually take place in this economy. And then, of course, what we have always said before, we've got a lot of other things compiled in some thick document called the National Development Plan. We must just go and execute. We will get growth going once again in this economy. That is, in essence, what it boils down to. Are there any other questions? Yes, ma'am. Follow up.
Just a quick one, Governor. With regards to the ANC's resolution to take steps to nationalise the central bank, is there any sort of update on that you would be able to share with us?
Yes, ma'am.
We've got one from Manali Messiah from Dutch Bank. Was yesterday's CPI print taken into consideration in the revised inflation forecast? And another one from Peter Worthington from Absa Capital. The MPC cited the upside risks to CPI from electricity prices. Has the MPC done any modeling of second round impact of possible electricity price hikes above the forecast assumption?
Thank you very much. Are there any other? Rashad, I see your computer is on, so you surely know something about electricity more than me. Will you deal with that question? In the future, there is nothing that we can do about yesterday's inflation. And so we have a forecast, and our reaction function is based on the forecast that, that we have actually tabled here today. Yesterday's inflation could affect something else, which would be the starting point of the next forecast. But as far as we're concerned, yesterday's inflation is yesterday's inflation. Rashad.
Yes, I guess the question that Peter is getting to is, you know, most economists can calculate direct effect of an increase in energy prices on the CPI. It's the indirect and the second round effect that is at issue here. Our forecast does take into consideration a second round effect, and that second round effect, you know, if you think that, you know, hypothetically a higher electricity price adds 0.3 or 0.4 to say 2018 CPI, the second round effect, the coefficient could be anywhere from 0.1, 0.2. One could have a big debate about is that an overestimate and an underestimate. But just to say that built into the model is a second round effect. That coefficient is not that easy to decompose. But what you should take in consideration is that when we do these different scenarios in a different forum which we can share, there is some built-in of a second round effect, and that's based on you know, largely historical behavior. When there is a supply shock, there is a response to a supply shock, whether it's kind of wage increases, whether it's contracts, or something of that matter. But that coefficient is obviously can be debated.
Nationalization of the Reserve Bank. Our position that we had articulated in the past stands. We shall await government to initiate a process, and we will engage with that process and make our views known. That is where we end up that one. Well, in the absence of any further questions, I will draw this to an end. Amokhelang, you are the last one.
Thank you, Governor. You've mentioned that you expect the rand as well as other emerging market currencies to be more volatile. Is the SARB or, you know, the MPC being held hostage by the rand? We've heard some economists saying that the SARB is on a tightrope given the rand's volatility.
We don't have to go on a rope. This building is very strong. Let me say to you that we are not held to ransom by the rand.